It doesn't matter how good your trading strategy is, if you're not using the right entry model, you are going to leave thousands of dollars in profit on the table every single week. The brutal truth is over 80% of traders enter their trades completely randomly. No timing, no analysis, no precision, and it is destroying their trading results. By the end of this video, I'm going to teach you the same entry model that my father taught me 5 years ago that I still use every single day. It's simple, it's deadly accurate, and if you can learn how to apply it correctly, it can literally add another 0 to your trading results every single month. Let's not waste any more time and let's hop right into making you a more profitable trader. If you're wondering why you should even listen to me in the first place, I want to be as transparent and as real as possible. This is my Charles Schwab brokerage account, and over the last 7 to 8 months from November 1st of 2024 to July 21st of 2025, I've made a little bit over $445,000 on my account, which is a cumulative rate of return of a little bit over 256%. And this is also considering I barely traded in the month of June. I was actually traveling throughout all of Europe. And a lot of people are going to say that this is a screenshot. This isn't actually my brokerage account. So I'm going to go ahead and refresh the page just to be real and transparent. If we go to November 1st of 2024 to July 21st of 2025, there you go. There's the 447,000 that I just showed you guys. And like I said, I want to be as transparent as possible. I want to show you that everything that I'm about to teach you are principles and concepts that I personally use in my trading every single day to make money. The biggest problem that I see with traders today is that they don't have a system, that they operate completely randomly. And the funny thing about that is most traders have random entries, random exits, random execution, random management, yet they expect consistent results. And that makes absolutely no sense to me. If you want consistent results, you need to have consistent input. You need to have consistent actions. And one of the first ways to, develop a consistent input is to have a very concrete entry model that you use for every single one of your trades. And I'm going to teach you the same entry model that my father taught me 5 years ago. And my favorite part about it is that it's incredibly simple. The strategies I trade are simple. The way that I enter those setups is simple, as you're about to witness. And in my opinion, the simplest things in life are oftentimes the most brilliant. I see so many traders overcomplicating their entries, overcomplicating their exits. Their strategies are complex, right? I like to keep things simple. And before I go into what this entry model looks like, it's really important that you understand intimately the strategies that I trade, because the whole point of an entry model is to enter setups, enter your strategies, right? If you don't have a strategy, you can't have an entry model, right? So it's important that I explain to you what my strategies are. And I'm gonna really simplify this. So if you're a beginner, you could fully understand what I'm talking about. But even if you're a veteran, experienced trader, you could still resonate and understand what I'm saying here. So what I want you to do is imagine that you just ran a marathon. And you might be thinking, marathon, running, like what does that have to do with trading? And bear with me, you're going to understand this in a second. I'm really going to simplify it for you. Let's say you just ran a marathon. You just ran the New York City Marathon. You ran 25 or 26 miles. I don't know exactly how much it is, but you just ran 25 miles. Are you going to be able to run another marathon? And I want you to think about that in your head right now. You just ran 25 miles. Are you going to be able to run another marathon? And honestly, unless you're David Goggins, you're not going to be able to run another 25 miles, right? Maybe David Goggins can do it where he could just run endlessly. He can run on his broken feet. But for you, you're probably going to need to rest, hydrate. You're going to need to relax. You're going to need to sleep, take a nap. You're going to need to eat, right? You're going to need to relax, right? Before you can run another marathon. You can't just run back-to-back marathons. Does that make sense? You obviously need to chill. It's very obvious. Now, the markets work in a very similar way. Prices never go up or down in a straight line. Prices cannot just go infinitely higher or infinitely lower in a straight line. That's just not how the markets operate or move. And very similarly to you needing to rest after you ran a marathon, the markets also need to rest after prices run a marathon. And that resting period that the markets need to do, that is called price correction. I'm sure you've heard of this before. Oh, the markets need to correct. Oh, the markets are correcting right now. I'm sure you've heard of that phrase, but hopefully this really simplifies it for you so you can actually understand it. So let's say you have an established trend, an established direction where prices are either going up or prices are either going down, right? Within that trend, there are price corrections. There are essentially moments where the markets and prices need to rest before they continue higher. And those corrections present opportunities for us as traders. And those are my strategies, right? And I'm about to show you. So there's two ways in which prices can correct, right? And I want you to try to even pause the video and think about it. What are the two ways in which prices can correct? Well, number one, prices can correct in the form of price action, in the form of a pullback, where the markets run a marathon, right? A buyer step up to the plate, they buy this stock up, and then buyers begin to sell, right? They sell and they take profits, and you see a correction through a dip or through a pullback, right? This is called a buy setup. And the same way, it works the same way if it's a short, right? So if it's going down, we have a downtrend, the markets correct and they get ready for the next move lower, right? So this is the first way the markets can correct, in the form of price, in the form of a pullback or a retracement. The second way in which the markets can correct is with time, in the form of a consolidation where prices move up, prices move up, and then literally prices rest. They stay at the same price area and they literally consolidate. They consolidate, or you could say this is a base, right? So they base, they consolidate, they rest. All of those terms are basically synonymous for this example, right? And then, of course, our goal is to trade the breakout. Once prices have finished resting, once enough time has passed where the markets are ready to run another marathon, well, that's our breakout. And the same thing applies if it's the opposite direction, if it's a short or if it's a base breakdown. We have a move lower, then the markets consolidate, they rest, they correct until they're ready to break down again. These are the only ways prices can correct. And as a result, these are my only strategies, right? I like to trade with the trend. I like to trade when, my stock or crypto or whatever I'm trading is moving in a particular direction. I don't like to trade sideways markets, right? Because they're difficult. I don't know what the direction is. I like to trade prices that are moving and have a catalyst, right? That are moving in a direction, whether that is up or down. The trend is your friend. That is such a good expression. And I live by that expression, right? I trade stocks that are trending in one direction, okay? Now, there's one more strategy I do trade, and this is essentially a reversal strategy, okay? And a reversal, you can think of it as it's like a trend exhaustion. So for example, let's kind of draw this out for you, what this would look like here. A lot of people gravitate towards trading reversals, which I'm fine with. However, if you're a beginner trader, you should stick with trading with the trend. It's way easier to trade with the trend than against it. But as you gain more and more experience, you can start trading against the trend and going for those trend exhaustion patterns. So essentially, let's say you have a really nice established uptrend. We're grinding higher, right? We are looking for exhaustion. So what we're looking for is the trend to go what's called climactic, for the trend to become exhausted, where you start off with an established uptrend and then the trend starts to go vertical. and the trend starts to accelerate. And once the trend accelerates to the point where, in this case, there just aren't any more buyers left up here, this is where you can go for a reversal opportunity and trade the counter trend it, basically. And you trade the reversal of this trend, okay? So these are the three strategies that I trade. I trade retracements, I trade consolidations or base breakouts, and I go for trend reversals whenever the trend exhausts itself and it's ready to move the other way, right? You could think of it as there's buyers that are buying this up, but at some point, once the trend goes vertical, there's no more buyers stepping up to the plate. And if there's no more buyers up here because they've already exhausted themselves, well, any amount of sellers are going to bring prices lower. These are the strategies that I trade. I don't trade anything else. And I combine level 2, I combine multiple time frame analysis, I combine gap trading with these strategies. And if you want to learn how I trade these strategies in detail, like exactly what I look for when it comes to a retracement or a consolidation or a breakout pattern or even a reversal, I teach all of this in depth in my free 10+ hour course, which is honestly significantly better than most paid courses on the internet. So feel free after this video to start watching my free course. It's in the description of this video, and it'll teach you the exact qualities I look for in these setups. And you could actually use this YouTube video in conjunction with all of my other free education to really, build the foundation for your trading and progress, okay? So these are the three strategies I trade. That's it. I keep it really, really simple. Okay, next, let's go into how I enter into these strategies, right? How do I enter into a reversal play? How do I enter into a buy setup or retracement or a breakout? Like, what am I looking for before I go into the trade? All right, and let's talk about that. So what we're going to be looking for is for very specific candlesticks, right? We don't just enter randomly. If we get a pullback, right, we get a move up and a pullback, it doesn't mean I just enter randomly. Or if we get a consolidation of a breakout, I don't just enter randomly. I'm looking for specific candlesticks, and I call these entry bars. And there's three types of entry bars that I really want to talk about in this video. The first one are narrow range bars. And like I said, I'm going to keep this really simple. What's a narrow range bar? Well, exactly what the name suggests. They're candlesticks that have narrow range bodies, narrow range bars, where the top of the candlestick isn't really all that far off from the bottom of the candlestick. And usually they have really small wicks, if any wick at all, right? So you don't want to see a massive wick for this, okay? We'll get into, massive wicks. We'll get into that in just a second here. But we're looking for narrow range candlesticks, right? There's not even that much explaining to do. You'll be able to identify these very clearly because they're simple to understand. They're just small candlesticks. Just think of it like that, okay? So we're looking for narrow range bars. What else are we looking for? Number 2, we're looking for Doji bars. Doji bars are some of the most powerful entry bars that you can find in the markets. Now, what does a Doji bar look like? So you can think of it like this. It's essentially a bar that's like this, and it doesn't really have a body. It doesn't have this portion of the candlestick. So in other words, the candle prices basically closed near the same price in which they opened at, right? So for example, here, prices opened here and they closed right here. They closed essentially exactly or very close to where prices opened at, right? And let's say this is a larger time frame. Let's say this is like the 5-minute candle or 10 or 15-minute candle, whatever. This is what it would look like on the smaller time frames, right? Where we open here, we start to move up right here, which represents the high of this wick. Then we start to drop. We make new lows down here, right? And then we get bought again and close right here. And if you look at it, this is kind of close to, not quite exactly, but we essentially opened very much near where prices closed. And that is what a Doji bar is. Now, a Doji bar represents uncertainty. It represents a battle between the buyers and the sellers, right? Because no one really won, right? Like if you look at, let's say, this candlestick, you could say, Well, it's a green body. Price is closed up here. Price is open down here. The buyers clearly won. The buyers brought prices higher during this candlestick's time frame. And the opposite would be true for this. If it's a red candlestick, right? We open here and then we closed here. So the sellers brought prices lower, right? Sellers took control and they brought prices lower, and that's what resulted in a red body. Now with a doji bar, it represents uncertainty, right? The battle between the buyers and sellers was like a tie. No one really won. And you could see it with this kind of, with this diagram here, right? We got bought, we got sold, then we got bought again, and we closed very much near the price of where we opened at, okay? So doji bars are excellent entry bars and reversal bars. And I'm about to show you that in just a second. Now, the third type of entry bar that we are looking for are bottoming or topping tails, just like how I just mentioned just a few minutes ago. So what is a bottoming tail? A bottoming tail is when we open right here, prices get sold off, they make a low, right, which results in this really large wick, and then prices get bought all the way back up to make a new high right here. And you can literally see on the smaller time frames what this looks like, right? We open right here at the bottom. This is a green candle, so we open at the bottom of the body. We get sold off, we create a low right here, and then prices get bought. The buyers take control and they bring prices higher, and it literally leads to a massive wick at the bottom. That's why it's called a bottoming tail, right? So whenever you see a bottoming tail, a really easy way to think about it is the buyers have taken control. The buyers have taken control. Even if this is a red bar, right? Like you might be wondering, oh, well, what if this is a bottoming tail, but what if it's a red body? Doesn't matter. The buyers have still taken control, right? Like let's say instead of closing up here, we closed right, let's say here, okay? Right here. This would result in a red candle, right? Because prices open here and closed here, let's say. I'm not going to draw out the full candle, but you guys get what I'm saying, right? It would still suggest that the buyers have taken control because the buyers stepped up to the plate at the lows and they brought prices higher. So regardless if it's a red or green candlestick, whenever you see a bottoming tail, it suggests that the buyers have taken control. Just remember that. Really easy way to think about that. The buyers have taken control if it's a bottoming tail. If it's a topping tail, well, it's the opposite. The sellers have taken control. Why is that the case? Well, prices open here. They got bought. They formed a high here. Formed a high here right there, right? And then the sellers took control here and they brought prices lower. And we closed all the way down here. And this is a red candlestick. But even if this was a green candlestick, it would be almost irrelevant, right? The sellers have taken control. That's the most important part. So if you see a topping tail, regardless if it's red or green, the sellers have taken control. It's a really easy way to think about it. And bottoming tails and topping tails can be fantastic reversal candles or entry candles. Okay, so these are the three different types of candlesticks that I look for when it comes to entering my strategies, when it comes to entering into retracements, or that's what a buy setup is, right? Or into breakouts or breakdowns, or into trend exhaustion plays or, reversals. Okay, these are the candlesticks I'm looking for: narrow range bars, doji bars, or bottoming tails. Now you might be wondering, okay, so we're looking for these candlesticks. How do we actually enter? Like, where do we enter? Where do we place our stop loss? So when it comes to a long, right, we're buying, we're going long, our goal is to place our entries always above the entry bars, and we place our stop losses below the entry bars. Now, that's if it's a long, right? So that's entry, this is stop loss if it's a long. Same thing here. If it's a narrow range bar, right? We have a narrow range bar. Our goal is to place our entry above the narrow range bar, stop loss below. Now, if it's a short, it's the opposite. Entry would go below the narrow range bar, right? Stop loss would go above. And I understand this is still confusing because you haven't seen any examples, but don't worry, I got a ton of examples for you. Okay, so let's look even here. With a topping tail, where would we place our entry? Entry above the topping tail, stop loss below. Okay, entry, stop loss below. If we're going short, it would be the opposite. Entry below the topping tail, let's say, stop loss above. That's what we're going for, and it's very, very simple. Okay, so now let's go ahead and look at some examples so you can actually understand how this works in practice. So right off the bat, for every single one of these examples, what I want you to do is actually pause the video and number one, find entry bars, and number two, figure out what setup is this. Is this a retracement? Is this a breakout or a consolidation? Or is this a trend reversal? This is what I want you to figure out. Okay, so pause the video and figure it out. But it should be pretty obvious. What's going on here? We have a nice move up. We have a 40 to 60% retracement, right? This is a buy setup. This is a retracement pattern. Great, perfect. Now, we always like to go for 40 to 60% retracements on our buy setup. So like I said, watch the free course. It's going to teach you all the qualities that I look for when it comes to trading buy setups. But where do we have entry bars? Well, we have a narrow range bar right here, kind of like almost like a topping tail, narrow range bar here, and then we have like a doji bar, right? So in this case, we have numerous entry bars, and you could say, hey, this is also a narrow range bar. So we have 4 entry bars in a row. Perfect. What do? We find the kind of like the highest one of those entry bars, which is right here. See how this tail extends past the highs of the other ones, and we would place our entry above this entry bar and stop loss below this entry bar. Okay, that would be our entry model. And what we would do is as soon as prices hit the highs of that bar, we enter. We don't wait for this candle to close. I already know I'm going to get that question. No, as soon as we hit the entry, that's when you enter and our stop loss goes below the entry bar. Now you might be thinking, okay, but why do I have to place it above this one? That's just because this is kind of the tallest one. But if you wanted to have a tighter stop, better reward to risk, which I'll explain how that works in just a second, you could even place your entry above this one, stop loss below. My recommendation is to always put your stop loss below the lows of the retracement, right? So this is the low of the retracement right here, stop loss below the lows of that retracement. And I would always give just a little bit of room. I wouldn't place it directly below. I would always give it like 2 to 3 cents or 5 cents below the lows of this retracement. Okay, excellent. So that's how we would enter this buy setup. Let's take a look at this one. What do we have here? We have numerous buy setups, right? We have numerous retracement patterns. We have a nice move up, kind of a deep retracement, but here we have a bottoming tail. So I'm going to use this bottoming tail as my entry bar into this retracement pattern, into this buy setup. So what I'm going to do is I'm going to place my entry above that entry bar, stop loss below. And it would have been triggered right here as this candlestick was forming. Now this candlestick led to being a topping tail. That's fine. It never came down and hit our stop. And then the next one obviously kind of ignited that next move higher. And of course, this thing ended up hitting target, which is the previous high. And even if you look kind of later into the day, right, we have another retracement right here. Right, we moved up, we retraced, and we have like a narrow range bar. Perfect. We can use this narrow range bar, entry above the narrow range bar, stop loss below the retracement. Perfect. And this is exactly how I would use these entry bars to get into this retracement pattern. Now, let's go ahead and continue. And in just a second, I'm going to be going over reward to risk and why this is important. Let's take a look at this example. So what is this setup? This is a breakdown. Right? We have a move lower, consolidation, right? Resting period, and then we trigger lower as a short. So this is a base breakdown. Now, what do we have here? We move lower, we get a couple of candlesticks. What is this right here? Some of you guys might say that this is a topping tail. Others may say that this is a doji bar. Doesn't really matter. But this is almost an attempt to move higher that led to a failure. So I would say this is more of a topping tail. This is a breakout failure, right? We attempt to break out We fail on that breakout, and that's confirmation that the trade and that the stock is moving lower, right? Does that make sense? We're basing, we attempt to move higher. That attempt failed, right? If an attempt to move higher fails, then that basically screams that we're going lower. And what you could do is either, number one, place your entry below the base, right? Which is actually technically the correct entry for a base breakdown, right? If you have a move lower, consolidation, entry is usually under the base, stop loss is over the base, right? But in this case, you could have even gotten creative and entered directly under this candlestick, right? Directly under this entry bar and this breakout failure, this topping tail, okay? So entry below this topping tail, stop loss above, and you would have caught this move lower. Or you could have done entry below the base if you wanted it to actually just clear the entire consolidation, stop loss above. And I mean, beautiful. It led to it, continuing lower the rest of the day. Okay, let's move on. Here is another beautiful breakout. So this is not a retracement. This is a breakout. We move up, or we actually get sold off. Then we kind of base for a while, and then we have a few very nice narrow range bars. Like every single one of these bars like a narrow range bar. So what do? Entry above the consolidation, above the narrow range bars, stop loss below the narrow range bars, and we would have caught this move higher. Beautiful. Let's go ahead and move on. What do we have here? This is another kind of consolidation retracement pattern, right? We have a nice move up. By the way, check this out. This is kind of like a little retracement. And what do we get? We get a little narrow range bottoming tail. Perfect. Entry above, stop loss below. You would have caught this move. And then we retrace. We begin to base. We begin to base. We begin to base. Bunch of narrow range bars, kind of like doji bars, bottoming tails. Perfect. Entry above, stop loss below. And you could even put your entry over the entire base, right? It's kind of up to you. Stop loss below. But we're using these candlesticks to enter, okay? Let's continue. What do we have here? We have another, what is this? A buy setup. It is a retracement pattern. We have a nice move up, and this was just the other day, actually. We have a nice move up. We pull back, get a doji bar here, and we get a big doji bar there. Perfect. Entry would be over the doji bar, stop loss below, and of course, it produced fantastic follow through to the previous high. Now, before we look at more examples, I think it's really important for you to understand why we're looking for small entry bars and why entry bars could have a massive impact on your reward to risk for every single trade that you take. And reward to risk is going to directly impact how much you make from your trading as well. And what I need you to understand for this is that the size of your stop has a massive impact on your share sizing, which has an impact on your reward to risk. And remember that with entry bars, we always place our entry either above the entry bar, stop loss below, if it's a long, or entry below, stop loss above, if it's a short. So the bigger the bar, in theory, the larger the stop would be. And I have a little bit of a diagram here that could really break this down if you're still confused. So right off the bat, this is our share sizing formula. So this is essentially the formula that tells us how many shares should we buy for that trade based off of our risk and based off the entry price and stop loss price. So the formula is risk divided by entry price minus stop loss price. And I want you to look at both of these examples here. What do we have? We have a consolidation here. We have a consolidation here, right? What's the biggest difference between these two consolidations? Well, it should be obvious. This one has a much bigger stop, right? Here, the entry's $3. Here, the entry's $3. However, on this variant, our stop loss is at 290. And on this variant, our stop loss is at 270. So our stop is much bigger for this consolidation, right? So entry's at $3, stop loss is at 290. The size of our stop is 10 cents, right? So let's take the formula. If we're risking $100 in both of these trades, right? $100 divided by 10 cents right here, because that's the size of our stop, equals 1,000 shares. So for this consolidation, we can buy 1,000 shares and still respect our risk, right? Because if we get 1,000 shares at $3 and it drops 10 cents to 290 and it hits our stop loss and we exit, we're only going to lose $100. But let's take this consolidation now. Our entry is at $3, stop loss is at 270. $3 minus 270 is 30 cents. 30 cents is the size of our stop, right? So let's put that into this formula. $100 risk, right? The risk remains constant, but our entry price is at $3. Stop loss price is at 270. So $3 minus 270 is 30 cents. So it's $100 divided by 30 cents, which again is the size of our stop. Just trying to emphasize this. That equals 333 shares. Meaning, if we get in at $3, which is our entry, with 333 shares, and it goes back down and hits our stop loss at 270, we're going to lose $100. We are risking the same amount of money on both of these trades. We're still risking $100. However, we are able to get 1,000 shares on this consolidation versus only 333 shares on this consolidation. Why? Because we have a tighter stop. Because the highs of the base, right, is relatively close to the lows of the base. Versus on this one, we have a big stop, right? Entry above the base, but it's a really sloppy consolidation, and the stop loss would go under. Does that make sense? So we're risking the same exact amount. However, we're able to get triple the share size for this consolidation because it's a much tighter stop. And remember, we already talked about all the way up here that we use entry bars to decide where we place our entry and where we place our stop loss. So if we have a really large entry bar, well, we're going to have a larger stop loss. As a result, we're going to have less of a reward to risk because we're not able to get as many shares. Does that make sense? All right, I'm going to repeat that one more time in case it doesn't make sense. The bigger the entry bar, the bigger the stop. As a result, we're not going to be able to get as many shares for the same risk. However, the smaller the entry bar, right, the tighter the stop, we're able to get more shares off of our risk. Does that make sense? We're risking the same amount, but the reward to risk is much higher because we're getting more shares because it's a tighter stop, okay? Hopefully that makes sense. So let's continue on and look at some more examples here. Let's take this one. This was actually just from the other day on open, okay? So what happened here? Let me get the white pen. So we have a nice little base, attempt to move higher. We pull back, and we have a retracement setup here. We have two really small doji bars. So entry above those doji bars, stop loss below, and of course, boom, it produced this move higher. So let's say, for example, I don't remember the exact entry here, but let's say it was at $3. That's not a good three. Let's say it was at $3. That's our entry, and our stop loss is $2.95. That is a 5-cent stop. So if we're risking, let's say $100, and it's a 5-cent stop, right? We can get how many shares? We can get 2,000 shares, okay? And this thing moved, let's say, 20 cents. 20 cents on 2,000 shares. That's pretty good. That's a pretty good profit for how much you are risking. And that's why we are going for small entry bars, tight entry bars, because we get a better reward to risk on our trades. Here's another example, and this is actually an exhaustion pattern where we gap down. This thing sells off. This is on United Health. Another gap down, another gap down. Look at this beautiful bottoming tail. The buyers took control, and I actually went long as a swing trade above this bottoming tail, stop loss below, and I ended up actually holding this as a core trade, even though it's not really working out that well. I'm still, I think I'm still up in the position, but this is the reasoning, right? We get a bottoming tail. This is our entry bar, so we enter above that tail, stop loss below. Okay, does that make sense? Let's look at the next example. This is also another example of a reversal pattern where, let me get the black pen out. We have a big move lower. There we go. Big move lower, big volume spike. We're extended from the 20. We are accelerating from the 20. So these are the things that we look for in our reversal patterns. We look for extension from the 20 MA. We look for acceleration from the 20 MA. We look for a volume spike, and we look for an entry bar right here. That is our entry bar. We get that bottoming tail. So entry above, stop loss below. And this is on the 5-minute chart. If you go to the 15-minute chart, well, it's really similar, right? You get that sell-off. We also have an entry bar in the 15. Entry above, stop loss below. So let's say you didn't have that much conviction it was going to work off the 5. You could have done it off the 15-minute time frame, okay? But if you wanted a tighter stop, a better reward to risk, then you would go to the smaller time frame and find a tighter stop to use. In this case, it would be over this bottoming tail. So what I do super frequently is I look at multiple time frames to see what's the best entry that I could get into that position. What's the tightest stop that I could use to get into that trade? So I'll look at smaller time frames to find a smaller entry bar, and then I can get a tighter stop, and as a result, better reward to risk. Or if I don't have as much conviction in the trade, I could use a larger time frame. Okay, let's look at another example right here. This is just a beautiful buy setup. We have a nice move up. We did get somewhat of a deep retracement, but check this out. This is called a shakeout bar. This is called a breakdown failure. And oh my God, is just beautiful. If you see something like this, where you have a move down, you base, and you see a bottoming tail in this fashion, I mean, that it just creates amazing potential long opportunities. Whenever you see a breakdown failure like this, it's just almost like close your eyes and go long, especially on this sort of setup, because this was on a bullish gap up as well. And I would definitely watch my trading model YouTube video. It's somewhere on this channel. I posted a few videos ago, and it kind of goes over how I trade breakouts and retracements on gapping stocks, and it'll explain how I find the stocks that I trade. So I highly recommend watching that video after you watch this one. But in this case, it's very, very simple. Entry above that bottoming tail, stop loss below. And if you want to use a tighter entry, you could even put or if you want to use a tighter stop, you could even put your stop below the lows of these narrow range bars, right? So this would obviously be a bigger stop if you put it here, so less reward to risk because you'd be getting less shares. And then if you use this stop right here below the narrow range bars, you would be able to get more shares because it's a tighter stop loss, therefore it'd be a higher reward to risk. But the risk in using a tighter stop is that it might shake you out, it might hit your stop and then go up anyway. Versus if you kept your stop down here, well, you kind of like eliminate that risk because you know prices aren't likely to hit that the bigger stop, right? And of course, we got that fantastic follow through. Okay, let's look at one more example here. What an amazing trend exhaustion pattern. We are basing, right? And then we just go fully exhausted, fully climactic. We have acceleration from the 20 period moving average. We have extension from the 20 period moving average. And we have this beautiful bottoming tail where the buyers took control. So in this case, entry above, stop loss below. And I think this was on the 15-minute time frame. You could even have went to the 5-minute time frame or the 2-minute time frame to find a tighter stop loss. Okay, but this was just a fantastic play, fantastic trend reversal pattern, and boom. And like I said, if you want to learn how to trade the reversal and the other key qualities that go into it, just watch my free course. Here we have a really bearish gap down, right? We get sold, big retracement. So I don't really like this kind of breakdown here. I don't like this setup, but you could say, hey, this is a really nice breakout failure. It attempted to move higher, it failed, and you could go short underneath this base, stop loss above. I don't love this setup, but that's, this entry was on the table since it was also a bearish gap down, right? And then, of course, we had fantastic follow through. Even here, it dropped. I like this setup a lot more, where we dropped, consolidated into the 20 period moving average, entry below the base, below these narrow range bars, stop loss above. It's a tight reward to risk and beautiful follow through. Same thing here, right? We retraced, get a couple of nice entry bars, entry below, stop loss above, and fantastic follow through as well. And even here, this could have been played as a reversal. You get a bottoming tail. I don't think I would have played this one, but we got a bottoming tail, entry above, stop loss below, and you could have caught the reversal. So another fantastic example. And those are all the examples that I have. So the point that I'm trying to make here, guys, is I use entry bars to enter my very simple setups. I'm entering into buy setups or retracements or buy the dip opportunities, or I'm entering into breakouts, or if I'm catching a trend exhaustion, right? I want to see, let's say the trend becomes exhausted. I want to see a nice entry bar here, whether that's a topping tail or a narrow range bar or a doji bar, and then I'm able to go short under it, stop loss above, and go for the trend reversal. So I'm looking for narrow range bars, doji bars, or bottoming or topping tails to essentially enter into these setups. And like I said, these are the only setups that I trade. And always remember, we're using these candlesticks to base our entry and stop loss from. So the smaller the candlestick, right, as we talked about earlier, the better the reward to risk, right? Because the smaller the candlestick, the tighter the stop, the more shares we can get for our risk, versus a really big entry bar. That means we have a bigger stop. That means we have less of a reward to risk because we have to get less shares for our constant risk, which in this case was $100. Hopefully that makes sense. And there's always a balance, right? Because you don't want to get shaken out. You don't want to have such a tight stop to the point where it could wick you out and then continue higher. So you always want to balance between having a really nice reward to risk and a tight stop, but you also don't want too tight of a stop. But you also don't want too loose of a stop because you won't get the reward to risk, right? Does that make sense? So, and this is how I base all of my entries off of these entry bars. It's extremely simple. And yeah, you could start applying this literally in your trading starting tomorrow. So hopefully you found tremendous value in this video. Make sure you leave a like, make sure you subscribe to the channel, and leave a comment if you found value in this video, and make sure you get started with my free 10+ hour course. Like I said, it is genuinely better than most paid courses on the internet. It'll solidify all of the information that I gave you in this video and on my other YouTube videos. So make sure you start watching it ASAP. It's in the description of this video. And if you are looking for more serious mentorship, you want a hands-on mentor, and you're looking to potentially become a full-time trader, I have a small group of traders that I take under my wing, and I personally help coach and scale from $0 to $10,000 to $50,000 a month with trading. My students trade live with me every single day. They learn how to trade by actually doing it with your mentor. So if you're looking for something a little bit more serious, you could apply also in the description of this video, and we could see if this is a good fit and if it would make sense for me to take you under my wing and actually mentor you. And make sure you watch my other videos as well. Watch my free course, and I'll see you on the next video that I make. Can't wait for you to watch it, and have a great rest of your evening. Thank you so much.